Hi everyone, my name is Busari Abiodun. Welcome to my channel. In this video, I'm going to discuss about IFRS 11. IFRS 11, that's joint arrangement. Under this video, I will be looking at the meaning of IFRS 11, joint control, that is what is joint control is, and objectives of IFRS 11. I will also be looking at the party to the joint arrangement, types of joint arrangement, that is the joint operation and the joint venture, and everything that has to do with the two will be looked at in this video. Also, what is separate vehicle in joint arrangement, and what is the financial statement of the parties to the joint arrangement. So how do we prepare their financial statement, and also I will be looking at accounting method, that is accounting method in joint ventures. Under this accounting method, we'll be looking at a situation where separate set of books are kept, and a situation where there's no separate set of book being kept in joint venture. So let's get started. What is joint arrangement? This is a contractual agreement between two or more parties to have joint control over an entity. That is, activities relating to joint arrangement is contained in IFRS 11, which was released by ISB on May 2011, and the application of the standard was started on the 1st of January 2013. And we will be looking at all the keywords in this definition, that is contractual agreement and joint control. So what is joint control? This is a contractual agreed sharing of control of an arrangement, which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. That is, when two or more business come together to carry on a business, before it can be regarded as a joint arrangement, that means key decision making must require unanimous decision on unanimous consent of the parties involved. That is, no party have influence over the other. For example, if we have three companies coming together, that is A, B, and C. If A is having 40% interest, B is having 40% interest, and C is having 20% interest. If it is required, according to the contractual agreement, that is at least 70% interest has to be agreed before any decision can be taken, which means if we look at it, see that is having 20% interest, there is no way it can influence decision making of such arrangement, which means A and B, which has 40-40 interest, without the two of them being agreed, there's no decision that can be taken. So A and B can be regarded as a party that are involved in joint arrangement, and C in that case is just an ordinary party. It does not have influence in the arrangement. So what is the objectives of this standard? So this is to establish the principles for financial reporting by entities that have interest in joint arrangement. That is, these standards shall be applied by entities that are party to a joint arrangement. So who are the parties to a joint arrangement? So parties to a joint arrangement refers to the entity that participates in joint arrangement, irrespective whether the entity has joint control of the agreement. So types of joint arrangement. So there are two types of joint arrangement as specified under the IFRS 11 by the IASB. The first one is joint operation, while the second one is joint venture. So we will be taking them one after the other. What is joint operation? This is a joint arrangement whereby the parties that have joint control of the arrangement have rights to assets. Let's take note of that. Rights to assets and obligation for the liabilities relating to the arrangement, which means before we can categorize the parties that they are into a joint operation, it means the parties involved must have right to the assets and obligations to the liabilities. So the parties that have joint control under the joint operation is called joint operators. Why joint ventures? If you are talking about joint venture, it's an arrangement whereby the parties that have joint control of the arrangement have the right to the net assets. So if we look at it compared to the joint operation, it has right to assets and obligation to the liability. But in case of the joint ventures, it only has right to the net asset of the operation. So that a party to a joint venture is called venturer or co-venturer, as is being called in some books. Now, what is separate entity? According to the under the appendix of the IFRS 11, a separate vehicle is a separately identifiable financial structure, including separate legal entity or entities recognized by the status, regardless of whether those entities have a personality. All these definitions have been given are according to the way they have been defined by the IFRS. So, in short, what the separate entity is talking about is a situation whereby under the arrangement, that is joint arrangement, is being stand alone from the business. So under this condition, a joint arrangement in which assets and liabilities relating to the arrangement are held in the separate vehicle can either be a joint operation or a joint venture. So that is, if an arrangement is under a separate vehicle, it can be a joint operation, it can be or a joint venture. And this depends on whether a joint arrangement is not structured through a separate vehicle. So a situation so when a joint arrangement is not structured through a separate vehicle, it is a joint operation. What this is actually talking about is directly or indirectly relating to separate entity. The business is standing alone. A situation whereby the parties to the arrangement still has right to the assets and obligations to the liability, despite the fact that the business is being standalone, that comes under the joint operation. But a situation whereby the parties to the arrangement only has liable to the net asset, that is joint ventures. That is what this is just talking about. So let's look at the financial statement of the parties to a joint arrangement, and we are going to start with a joint operator. So for a joint operator, the account for assets, liabilities, revenues and expenses of a joint operator depends on the contractual agreement. So for an entity that acquire interest in a joint operation in which activity constitutes a business as defined by IFRS 3, that is business combination. So such entity applies all the principles of business combination accounting in IFRS 3, or else those that conflict with guidance of IFRS 11, that is based on the contractual agreement, if the kind of the arrangement the parties be entered is in relation to IFRS 3, that is business combination, which as if the parties come together to form a business. So the treatment will be in line with the guidance of IFRS 3, which is business combination, or else it contradicts the what is being stated under the IFRS 11, that is joint arrangement. So for other parties we are talking here, we are talking about all those parties that does not have joint control of the operation, that the decision making does not really require, that cannot influence the decision making of the joint operation. So according to the paragraph 23 of IFRS 11, so the joint operation shall account for the interest in the arrangement and in accordance with IFRS 3 if the parties has right to the assets and obligation to the liability, although they may not have influence over the key decision making, but as long as the party have right to the asset and obligation to the liability, they will still be treated in line with IFRS 3, which is business combination. So let's look at a joint venture. So a joint venture recognizes its interest in a joint venture as an investment. In that case, that shall be accounted for as investment. That is according to IAS 28. That is investment in associate and joint venture. For a joint venturer, that is how they will be going to account for the interest of the parties involved. That is as investment in associate and joint venture. As stated by IAS 28. And or health is exempted from applying the equity method based on the forms of the interest. So as contained in the paragraph 24 of the revised standard. So there is only a waiver and which will be determined based on the agreement of the arrangement. So what of the parties to a joint venture? Which means we are talking about parties to a joint venture. We are talking about all those parties that does not have control, that is over the entity. So a joint venture account for the interest in accordance with IFRS 9, that is the financial instrument, that is any party to a joint venture that does not have control over the decision making. The account of such party will be accounted for in line with IFRS 9, which is a financial instrument, unless it has significant influence over the joint venture, under which an account for the account for it in accordance with IAS 28. So now accounting method in joint venture. How do we prepare account under the joint venture? So under this accounting method applied by a joint venture depends on whether one, the venturer maintain a separate set of books, that is the the book of account being maintained for the joint venture separately different from the one being maintained for the business. That's what this one is talking about. While the second one, the venturer does not maintain a separate set of books. So the kind of the account that will be prepared in the two occasions different. So let's start with a situation whereby a separate set of book is being kept for the joint venture. So this is used when large transactions are involved and the operation will continue for a long period of time. So due to that, double entry principles are applied in preparation of the account. So and as a result of that, three accounts will be prepared. That is, one separate set of books is being kept for the joint ventures. Three different accounts will be prepared. The first one is joint bank account. The second account that will be prepared is joint ventures account, while the third account that will be prepared is venturers account or co-venturers account, just like I said. So let's start with the first one, joint bank account. This account is equivalent to cash and bank account that we have, which means all receipts will be debited to the account. That is, all money received will be debited to the account, while all the payment will be credited to the account. If you are talking about money received, we are talking about the contribution by each of the venturers, that is their capital contribution in form of cash or bank will be debited to the account, and other income, while all the expenses will be credited to the account, and the balance of the account at the end of the period will be used to settle the venturer. That is, the balance of the account is paid off to venturer, leaving no balance left in the account. So this is used when large transactions. So just like I said, so now what of joint ventures account? So joint ventures account, on the other hand, is prepared to determine the profit or loss made in a joint venture. So unlike the normal business where we have trading profit and loss account, for a venturer, the account that is being prepared to determine the profit or loss made in the operation is what we call joint ventures account. And debited to this account is the amount of purchases and all the expenses being incurred during the operation. While sales, the amount of sales, the closing stock or closing inventories, drawings, among others, are credited to the account. So the balance of this account represents the profit or loss which is shared among the venturers. So in case there is a credit balance, that is, the credit side is more than the debit side, so that indicates a profit and that will be shared among the venturers. But a situation whereby the debit balance is being made, so that represents a loss, and the loss will also be shared among the venturers. So now the last one, which is co-venturers account or venturers account. So for the venturers account, this is represent the capital account of co-venturers. So the essence of this account is used to account for the contribution and the expenses of the co-venturers in relation to the business. So the essence of this is to know the contribution of each of the venturers and their expenses. At the end of the day, they will be able to determine the amount to pay off to each of the venturer. So credit to this account are capital contributed by each of the venturers. The purchases, a situation whereby the venturers purchase some goods, some items, so to contribute to the venture, so it will also be credited to the account, or the venturer supply some goods from their store to the venture, it will also be credited to the account, while all the expense and as well as the expenses, while all the amount of sales, drawings, and asset takings will be debited to the account. So the venturer share of profit, in case there is a profit, will, in case there is if it is a debit balance, a loss, so that will be debited to the account, while when the venture has a profit from the joint ventures account being prepared, that will be credited to the account. So just like I said, as at the end of the day, the balance will determine the amount to be paid off to the venture. In short, just like I said, where a separate set of books are kept, so like I said, three accounts will be prepared. We have joint bank account, joint ventures account, and co-venturers account. These are the three accounts that will be prepared. Now let's look at a situation where a separate set of books are not kept. So a situation whereby a separate set of books are not kept under the joint ventures, there are two approaches to keeping financial records of the joint ventures. The first approach is that each venturer keeps a complete record of joint ventures transaction. That is, each of the venturers will keep record of the account of the joint ventures. The second approach is that each of the venturer will keep record of only their own transaction. So they are after their own transaction in the joint venture. So those are the two approaches. So let's take the first approach, a situation whereby each of the venturer keep the complete record of the transactions in a joint venture. In this situation, each of the venturer keeps his account and also keep the account of the co-venturer, that it will keep his own account as well as the account of the co-venturer, that is other venturers. So in that case, two accounts will be prepared, which are joint ventures account and co-venturers account or other venturers account. So note that the essence of the profit or loss from the joint ventures account is transferred to the profit and loss account, while the co-venturers share of profit is posted to their various personal account. Just like I said, since each of the venturer are preparing the accounts, which means they did not separate the account from that of their business, which means by the time they prepare the joint ventures account, their own share of profit will be transferred to their own trading profit and loss account, while the other venturers share of profit will be transferred to each of the venturers personal account being prepared. So that's what we are saying here. So now, a situation whereby the venturer prepare only his own account. So in this case, each of the venturer keeps records of only his own transaction. So and the account that will be prepared will be opened as joint ventures with dash. For example, Mr. A and B are into joint operation and each of the joint venturers keep record of their own transaction. If Mr. A is going to prepare account, Mr. A is going to prepare account of joint operation with B. If Mr. B is going to prepare his own account, he's going to prepare his own account as joint venture with A. So that's what this one is saying here. So and the venturer does not take record of other venturer. Just like I said, it record just only his own account. And an account called memorandum joint ventures account is prepared to determine the profit or loss. Now the question is, how do the venturer prepare this account? So like I explained earlier, each of the venturer will prepare their own account. So after preparing the account, they will now share a copy of that account with other venturers. So when other venturers get a copy of that account, They will use the copy of that account along with their own account to prepare an account called memorandum account. And this account is called memorandum account because the account does not form part of the double entry principle. So it is a memo that is a single account just to determine the profit and their own share of profit from joint operation. It does not form part of the double entry principle, and that is the reason why it is being called a memorandum account. So in summary, just like I say, a situation whereby a separate set of books are not kept under the joint venture. So I said we have two approaches, that is each of the lecturer keep complete records of his own transaction. Second approach is that each of the lecturer keep record of only his own transaction. So a situation whereby each of the venturer keep complete record of the transaction, two accounts will be prepared, which are joint ventures account and co-ventures account. A situation whereby each of the venturer keeps record of only his own transaction, like I said, one account will be prepared, which will be titled joint ventures account with dash. So why a memorandum account will be prepared to determine the profit or loss made in a joint operation. So that is the end of this tutorial. In the next lesson, I will be taking an illustration on joint ventures where I will be applying the two approaches. That is a situation whereby each of the venturers keep complete record of joint ventures account, and a situation whereby each of the venturer keeps only record of his own account. And this is the question we will be treating in the next tutorial. So don't forget to subscribe to the channel.